thanks so much for tuning in. This is ET Now Spotlight and I'm Alex Matthew. For generations, Indians have sworn by gold as an investment of choice. And because India doesn't mine as much gold as certain other countries, we tend to import quite a bit of it. That has a lot of implications in and of itself. Now, of late, demand for gold has not been as much as it has been in the past. And this week, a lot of focus has been devoted to gold because of the crash in prices at the start of the week. It's been called a flash crash. What are the implications of that fall in prices? Why did it take place? And what is a strategy that you should ideally employ when it comes to buying gold? Those are some of the questions that we will ask on this episode of ET Now Spotlight. But we will start, as we always do, with the context. Gold. It's been one of the oldest and most abiding stores of value known to man besides land and livestock. It was first minted into coins around 2,600 years back, but even thousands of years before that, it was still a prized possession. And it isn't just its attractiveness and malleability that contribute to its perceived value. It is also very scarce. The World Gold Council estimates that at the end of 2019, less than 200,000 tons of gold had been mined throughout history. To put this into perspective, all the gold ever mined over the last several thousand years could easily fit into 4 Olympic-sized swimming pools. But more than its scarcity, it has been the universal acceptance of gold, its fungibility, that has helped retain its importance in the financial world. Having said that, some of its prominence was lost when the gold standard that was used for many years to determine the value of currency was replaced by the US dollar, which became the benchmark for all other currencies. Internationally, gold is often viewed as a safe haven, or in other words, an asset that helps preserve value when other asset classes like equity go through significant downturns. It is also viewed as a hedge against inflation. Strong buying by central banks around the world in 2019 and by exchange-traded funds in 2020, coupled with the uncertainty brought on by the COVID-19 pandemic, propelled gold prices to their all-time high of over $2,000 per troy ounce in July last year. In India, they touched a peak of over 56,000 rupees per 10 grams around that same time. But after they hit those heady levels, prices of gold and in fact other precious metals have cooled off. In fact, gold prices over the last 10 days have dropped quite dramatically. And the events that are believed to have caused the fall could in fact be a precursor of more similar price action down the road. First, on Friday, a report showed that the number of jobs in the US rose by the fastest pace in a year in the month of July, despite fears of the Delta variant of the COVID-19 virus. This lends credence to the recovery underway in the world's largest economy, and that in turn raises the prospect for the tapering of stimulus by the US Federal Reserve. The expectation of rate hikes down the line and the rolling back of the Fed's bond buying program helped the US dollar strengthen. A large factor in the dominance of gold last year was the weakening of the US dollar. If the greenback reverses that trend, it could put pressure on gold prices. And another major factor in the relative underperformance of gold this year has been the drying up of demand from exchange-traded funds. According to the World Gold Council, there were only modest net inflows of 40.7 tons into gold ETFs during the second quarter. These inflows only partially offset the heavy outflows the industry witnessed in the previous quarter, making 2021 the first year since 2014 with net outflows in the first 6 months of the year. What's more, ace investors like Jim Rogers are not too keen on buying gold even at these levels.
I'm not buying either at the moment, but again, I'm not a good trader, but I am waiting for silver and gold to correct even more. If I were buying today, I would buy more silver than gold. Silver is down 50% from its all-time high. Gold is down 10% from its all-time high. I'm not buying either at the moment, but when I buy again, I will probably buy a lot more silver than gold.
To be sure, the return of demand in India, particularly for jewelry, is expected to provide some support to prices. Already, demand for gold jewelry in the country in the second quarter was up by 25% over the low base of last year. And with restrictions easing ahead of the all-important festive season, demand could rise even further. In Mumbai for ET Now, this is Alex Matthew. Alright, so we've established that there are several factors at play on the global level that are having a bearing on gold prices. But there's one factor that we in India are all too familiar with, and that is the love that Indians have for gold. What kind of an impact would a significant recovery in demand for gold have on prices of gold globally? That's one question that I'm hoping to get answered in my next conversation. And let me introduce you to my guest. We've got Somasundaram PR, who is the Regional Chief Executive Officer India for the World Gold Council, joining in. Thank you so much, Mr. Somasundaram, for taking the time. But before we get into the aspects of what the demand scenario is currently and what the outlook is going forward, I want to understand the importance of India, or where India stands with regard to the global picture and the global demand for gold. If you can put a few numbers that will put that into context.
Yes, India is a very large gold consuming market. It is the second largest gold consuming market in the world. It has been number one till about 2010, but China became number one since then, and India holds the number two position. Between India and China, total demand is about 60% of the global demand. So that's the size of India. India alone could be between 25 to 30%, depending on whether the year is good or not.
Absolutely. So it's very significant, and the fact that we don't mine a lot of our gold, so a rise in demand could in fact have a large bearing. But let's talk about the demand. Based on the report that you released at the end of July, we talked about the fact that there has been a recovery, Mr. Somasundaram, in demand for gold in India, but it's still incredibly soft, isn't it?
Yes, it is. It is the second, what I would say, lowest second quarter demand. When we say second quarter, we talk about the calendar year, quarter two, June quarter, second lowest June quarter demand in our data series since 2000. So while there has been a recovery, of course, 25% jump in jewelry, 7% jump in bars and coins compared to the same period last year, a 73-ton demand is one of its lowest. Normally, you would expect closer to 200 tons in the second quarter, the June quarter, because it has got Akshaya Tritiya, it has got wedding dates, but 73 is one of our lowest quarters.
Understood. I do want to talk about the demand scenario right now, because we have a situation where the COVID-19 pandemic is ebbing even as we speak. You have cases at less than 40,000. There is a fear and an overhang of the Delta variant, but at the same time, there is hope that vaccination, Mr. Somasundaram, is gathering pace. A lot of people going in for their second jabs now. In that context, what is the best case scenario for demand for gold and particularly for jewelry, considering that the festive season is just around the corner?
We expect a growth clearly over last year. Having said that, I must say this year we have again desisted from giving a full year forecast, because it is very difficult to estimate what is going to happen during the season, whether the social restrictions will continue. Weddings are one of the important drivers of demand. How those weddings, how are they going to really happen in the society? So all these questions are still there before us. One thing clearly is there is a lot of latent demand. And will this come up during this Diwali Dhanteras season, or will it probably come out in 2022, something we have to wait and see. Prices have softened, so it is a good opportunity for consumers to step in now. Having said that, it is to give a full year forecast, there are a lot of factors this year which cannot be accounted for. We have, just to give you an example, we have seen quarters where India has got 300 tons of gold. And therefore, if you have a similar quarter in say, this fourth quarter, you could have a demand as close to 700, which was the pre-COVID year. But we still don't know what are the factors which are going to affect the buying patterns.
Understood. Uh, and this is very difficult to anticipate, Mr. Somasundaram, and I know that you don't have guidance or an expectation that you provide in the media with regard to your expectation of gold prices, but assume that they soften from this point on as well, which a few people globally are suggesting that it could. Could you then say that demand will rise even further in India?
Yes, certainly it would. We have always seen that, in gold price, India is not a price. India is a price taker, and generally demand in the short run is an outcome of price. It's not the other way. It's not that demand goes up, therefore price goes down. Question here is, price is fixed by a lot of global factors, primarily interest rates in the Western markets, and based on that, consumers' behavior changes in the short run. In the long run, of course, demand is a very important factor. There's no doubt about it. So if the prices soften, and if they soften further particularly, then I think you will see a huge spike in demand in this Diwali season.
Absolutely. Thank you so much, Mr. Somasundaram, for putting that picture in perspective. And clearly, if that demand does come back, I think a lot of people globally are watching very closely to see if that pans out, because that could in fact provide some support to prices going forward as well. It's been a pleasure speaking to you. Thank you so much for taking the time.
Thank you.
Alright, so let's delve a little deeper into what's at play in the market for gold, and in fact in the precious metals basket as a whole. Joining me now is Sugandha Sachdeva, who is Vice President Commodities and Currency Research at Religare Broking Limited. Thank you so much, Sugandha, for taking the time. I'm actually quite keen on understanding. I've laid out at this point some of the factors that are at play globally, but I also want to understand, if we rewind, say, about a year and a half, I want to understand from you, as a watcher of commodities and specifically gold, has this commodity behaved like it normally has over the last decade? Just so that my viewers have a little context for the rest of this conversation.
Yeah, hi, good evening, Alex. Yes, I think gold has definitely acted as a very good proxy. See, in times of the peak of pandemic last year, we saw gold prices surging to record highs. And when they surged in international market to a level of $2,100, very close to 2,100 an ounce. And in domestic markets also, they scaled to new record highs of around 56,191 per 10-year. But then after that, as the global economy has been picking up pace, and we are seeing a lot of risk on sentiments in the market, definitely gold is having a bumpy ride. The safe haven demand for gold has kind of dimmed. It's been a bumpy ride for gold. More so, especially all because the US economy is growing at a robust pace. And if you also see the recent jobs figure from US, that is indicating that labor market is showing a strong recovery. So all of these have kind of raised concerns that Fed is likely to dial back its ultra easy monetary policy very soon. So these are the concerns which are actually pressurizing gold prices at the moment. And with the kind of risk on sentiments, I think it will take some time for gold to recover its lost sheen, which we have seen over a period of last 12 months. It was in last August itself that we saw gold prices scaling high. And at this month, we have seen prices dipping lower to a 4-month low. So I think it will be some more time that this pain is likely to continue in gold prices, because the risk on sentiments are alive in the market. Global equity indices are trading at record highs. And I think the clarity about the Fed stance going forward will be more towards the Fed chair speech at the Jackson Hole Symposium. Market is likely to assess the growth outlook for US economy and the outlook for inflation, as well as the labor market. So these factors would dictate the direction of gold going forward as well.
Absolutely. You've somewhat answered a few of the questions that I have, but I also want to understand one of the characteristics, I think, over the last year or so has been the somewhat divergent nature of some of the metals in this precious metals basket, particularly silver and gold. How would you describe that? Because silver has come off, I think, much sharper than gold from its all-time highs.
Silver by its very nature is highly volatile, and it takes cues from gold as well as from the base metal complex. We saw Sharp surge in silver prices in 2020 amid the sharp surge that we saw in base metal complex. And as the global economic recovery was picking up, silver also was also kind of getting a lot of benefit out of that. And we saw strong gains of close to 40% in silver in 2020. But this year, the gold silver ratio has come down sharply. And we are seeing sharp sell-off that has come in silver prices. Even though the fundamentals overall are still pointing towards a significant upside in silver, because if you see silver prices, they are trading at a significant discount to record highs of $49 that we've seen in 2011. But then if you see gold prices, they were already tested record highs. So I think there is much more headroom in silver prices to rise from here on. But yes, at the moment, prices are under pressure. It's basically the rise that we have seen in greenback, wherein greenback is holding very close to 4-month highs, and the concerns about the early tapering. So all of these factors are pressurizing silver prices. Plus, the mine supply has also increased in silver this year. Earlier, there were a lot of supply disruptions last year because of the pandemic, but then mine supply is also improving. So that is also curtailing the rise in silver prices. But then I think it's just a correction which is going on. We feel prices will take a very strong support at levels of around 21 an ounce in international markets. And if I talk about domestic markets, 58,000 mark is likely to provide a very strong cushion to silver prices going forward.
Okay, let's go back to talking about gold then. And you mentioned some of the factors at play. You talked about the US economy doing better. You talked about the Fed tapering. And you also spoke about the fact that everyone's going to be watching Jackson Hole. The greenback is getting stronger. So all of these factors coming at a time when I think, if you can call it that, gold is a commodity that does very well as a momentum trade. And with all of these factors working against it, seemingly it's going to have a soft period ahead. The question is, how far will it fall? Is there any thought that you put in terms of the research as to what levels it could test on the downside?
Yes, I think in near term prices will witness some more decline. There is some more decline on the cards. See, if in international markets we look at the level, the 1618 area is likely to act as a very strong support area. It's a sacrosanct level, which has been holding quite well for last 6 months. So I think 1680 area will be protected. Only in case 1680 area is breached, we are looking at further declines towards 1570 to 1550 an ounce in international markets. Talking about the domestic markets, prices have recently breached the key support of 46,500 marks and they are headed lower. For domestic markets, I feel 44,200 to 44,700 is a good accumulation zone. I feel there would be strong buying interest that will be seen in gold prices at lower levels. So from a longer term perspective, the narrative is still very strong because if you see inflation, that is quite hot at the moment and it's likely to be further sticky in US especially. And also the COVID-19 curve is still creating a lot of uncertainty and there is a lot of uncertainty about its growth impact as well. Plus interest rate hike is still quite far away. So shorter term, there can be some pain, but yes, longer term narrative is still very positive. So I feel some more declines will be there, but then that should be acting as a very good opportunity for buyers to actually step in. And over a long-term period, we are still very positive on gold outlook. And I think in medium term, we can look forward to levels of around 48,000. And from a slightly longer term perspective, I would say first quarter of next year, even 60,000 levels are quite possible. Wow. But yes, I think that's likely to take some time. So we are in a corrective phase as of now. But yes, lower levels would definitely provide buying opportunities.
No, Sugandha, so I'm just going to, and this is my last question, right? Because I think a lot of people tend to mistake buying as personal consumption, and this is obviously a personal finance topic of conversation as well, with investing in gold, right? But assuming that we have viewers that are investing in gold, you're saying that you can buy at levels, if they decline further, for a substantial increase even by next year?
Yes, Alex, I feel that by next year, I think equity valuations, if you look at the equity valuations, they're quite stretched. And I think over a period of time, investors are definitely likely to feel the pinch of higher valuations. So money will certainly come out of equities and money should flow into gold for portfolio diversification as well as a hedge against inflation. Because inflation is likely to be persistent going forward. And that is a factor which markets at the moment are kind of ignoring. So I think that is a factor which is likely to play out and benefit gold prices over a longer term period. So I think overall outlook still very positive. If you look at the longer term charts, they are still indicating further upside for gold. But yes, it's just a time wise and a price wise correction, which I would repeat, just a period of consolidation which is going on in gold.
My last question, okay, I'm going to add just one more. One might point out that the kind of flows into ETFs, gold ETFs globally, indicate something that is a little bit different in that you have a phase where last year you had significant buying, but then in the second half of last year and the first half of this year, it has been a little tempered, that kind of demand from ETFs. Is that something of a concern where globally you may not see the kind of demand that you saw last year?
See, it's only when the prices start to rise significantly that investors' interest would definitely come back. See, as of now, there is so much of risk appetite in the market, so money is definitely flowing into risky assets. So once we see this COVID-19 curve, in case the cases start to rise further, and I also feel that the global economic recovery is likely to peak out very soon. So at that point of time, investors will definitely be drawn towards gold ETF once again as well. So as of now, yes, for the first half of 2021, we have seen significant outflows, but then money is certainly likely to come back into gold ETFs. Also, if you see, central banks have again started to buy gold. Last year, they were not buying so much of gold, but then again, central banks have shown so much of interest in gold at lower levels. So I think lower levels would certainly entice buying interest. So money will certainly flow back into gold ETFs as well, and that will provide further cushion to gold prices going forward.
Thanks so much, Sugandha, for sharing your views on gold, and it's always a pleasure speaking with you. Do remember, and this is for the rest of you, that from the perspective of your personal finances, a thumb rule that advisors often use is that you should separate the purpose for which you're buying gold. You should look at gold that you buy as your investments differently from the gold that you decide to wear. And the gold that you buy as your investments should not ideally cross 10% of your overall portfolio. That's just a thumb rule. You can decide the ratio that best suits your requirements. That's a wrap on this edition of ET Now Spotlight. It's been a pleasure bringing it to you. Thanks so much for tuning in. This is ET Now.